Welcome to the deep dive. We're here to take that stack of research you have, all the reports, the data, the summaries, and turn it into a real, usable insight, a shortcut to being genuinely informed.
Today, we're taking on a giant, a really foundational principle of investing, actually. We're challenging the classic Jack Bogle philosophy about U.S. versus international stocks.
Right, and we're not just going to talk about, PE ratios and valuations. This is bigger.
It's much bigger. The conversation has to be structural now.
Exactly. We're framing this whole deep dive around a threat that's coming, and it's quantifiable. We're talking about the global supply chain crisis that's really forecast to hit hard in 2026.
So our mission today is pretty straightforward. We're going to connect financial safety with hard logistics data and build a contrarian thesis, we're calling it. Why Jack Bogle is wrong about 2026.
Basically, we're going to show you why the stability of your S&P 500 index fund is now completely tied to the physical movement of a container ship thousands of miles from U.S. shores.
Okay, let's unpack this.
Let's start with what we all know. The conventional wisdom. Let's call it the Bogle barrier.
Sure.
The advice, and it's been fantastically successful advice for decades, was simple. You don't really need international stocks.
Right. The thinking was that U.S. companies, the Apples and the Amazons of the world, they make so much money globally anyway.
So by holding the S&P 500, you're already capturing global growth. You get the upside without the headaches.
Exactly. Without the currency fluctuations, the foreign political risk, the tax complexities. And we have to give it credit. That strategy was powerful. It was simple, it was low cost, and the returns were there. It was a sacred cow.
But even before we get to the supply chain piece, that argument was already starting to look a little shaky, wasn't it?
Yeah.
What are the sources saying now about future performance?
You're saying the tide is turning. I mean, if you just look at valuations, U.S. stocks are expensive.
Right.
They're near historic highs, which usually means lower returns going forward.
And international stocks.
They look cheap in comparison. But it's not just about chasing returns. It's about risk. It's a hedge.
A hedge against what, specifically?
A hedge against the worst-case scenario at home. Think about a long period of stagflation in the U.S. Low growth, high inflation. If that happens, you absolutely want assets that aren't tied directly to the U.S. economy. International stocks give you that buffer.
So on a purely financial level, the old rule is already under pressure. But you're arguing something much more urgent. You're saying even if that doesn't convince you, there's a huge structural risk that just breaks the rule completely.
That's it, exactly. The old rule worked because it assumed the physical world was like a stable, cheap, and reliable utility. Just humming along in the background.
I mean, it's not anymore.
That assumption is totally invalid now. We're entering what we're calling the collapse of the physical handshake.
The physical handshake, what do you mean by that?
I mean, the simple act of getting a product from a factory to a customer. All those U.S. company earnings you hold in the S&P 500, from tech to retail, depend entirely on ports working, on ships moving, on customs clearing. If those physical choke points fail, S&P 500 earnings just choke.
That sounds pretty dramatic. What's the specific evidence for this risk hitting in 2026?
Okay, so we're tracking three major risks that are all coming to a head. First one is geopolitical disruption. This isn't theoretical. It's happening right now.
The Suez and Panama canals.
Yep. Our data shows that between February and October of 2024, transits through those canals fell by over 40%. 40.
Wow. And the rerouting, that's not a small detour?
It's massive. It adds about 10 days and 3,000 nautical miles to a voyage. That's a huge increase in fuel costs, in shipping costs, and it slows down the entire cash cycle for a company waiting on those goods.
And this geopolitical mess is now slamming into a second risk, a financial one. You're calling it the carbon cost shock.
This is the one that really makes the problem unavoidable in 2026. It becomes a line item on an invoice. The EU is basically hitting companies with a double charge.
Okay, break that down for us.
So first, you've got the emissions trading system, the ETS. From 2026, carriers have to pay for 100% of their maritime emissions. That's a direct surcharge on the voyage. But then, at the same time, the Carbon Border Adjustment Mechanism, or CBAM, kicks in.
Right, CBAM. That was just a reporting thing before, but now it's about payment.
It's about enforced payment for carbon-heavy imports like steel, cement, aluminum.
So wait, let me get this straight. A company importing, say, style parts into Europe, they could get hit with the ETS surcharge from the shipping line, and then they have to pay the CBAM tariff at the border for the carbon embedded in the steel itself.
It's a 1-2 punch.
Yeah.
And it's already being priced in. We saw Hapag-Lloyd's surcharge tables from late 2024. They were already listing 21 euros per container just for the Asia to North Europe route.
That is just a direct hit to the bottom line. It's not a risk anymore. It's a cost.
It's a non-negotiable cost.
Yeah.
Money that used to be margin is now just a tariff.
Okay, so we have geopolitics and we have carbon costs. What's the third risk?
The third one is the one that can stop everything cold. The cyber-physical shutdown.
This goes beyond just stealing data.
Way beyond. We're talking about industrial ransomware and even more sophisticated nation-state campaigns. Groups like Volt Typhoon that are specifically targeting critical U.S. infrastructure. They're not trying to steal customer lists. They're trying to shut down the port's operating systems.
So an attack on a port in Asia could directly impact, say, Walmart's stock price here in the U.S. Is it that direct?
It is terrifyingly direct and immediate. If a major terminal like Shanghai or Singapore goes down, the goods don't move, period. Factories run out of parts, shelves go empty, and revenue forecasts just evaporate. We saw a real-world test of this when DP World Australia got hit in 2023. They had to execute their full shutdown playbook. This is an existential threat for any company that depends on inventory.
Here's where it gets really interesting. So if these risks are so clear, so quantifiable, it completely changes the game for the average investor. If you only own the S&P 500, you are making a massive, unintentional, and completely unhedged bet.
A bet on the operational efficiency of foreign ports.
Exactly. You're betting that Shanghai and Rotterdam can handle all this pressure better than Los Angeles or New York.
And that is a blind bet. The data doesn't really support it. Let's quantify that reliance. Let's talk numbers.
Lay it out for us.
Okay, so about 80% of all international cargo moves by sea. It all goes through ports. And when you look at efficiency, global trade is centered abroad. 18 of the top 25 most efficient container ports on the planet are in Asia.
18 of 25.
Yeah. The Asia-Pacific region just dominates the whole smart port market. U.S. companies absolutely depend on that foreign efficiency.
And the gap, the efficiency gap between those ports and ours is, well, huge.
It's not just big, it's a chasm. So a top-tier port like King Abdullah Port averages 97 container moves an hour. 97.
Okay.
Now, compare that to major ports on the west coast of North America. In 2021, they averaged just 26 moves per hour.
26? That's almost a 4-to-1 difference.
It's a massive difference. And that gap, that foreign friction, is a direct risk to U.S.-based earnings. A company in your S&P 500 fund is completely exposed to that inefficiency.
So how does that risk show up on a company's P&L statement? How does it translate into dollars and cents?
It forces a total change in how companies manage risk. It's not a buffer on the balance sheet anymore. It's a transparent expense.
Yeah.
The whole game now revolves around two concepts: time to recover, or TTR,
Okay.
and time to survive, or TTS.
TTR and TTS. Is
Yeah.
this an example?
Sure. Let's say a car company has only 14 days worth of a critical microchip. That's their time to survive, 14 days.
Right.
But a cyber attack hits the port where those chips arrive, and it causes a 21-day delay. That's the time to recover. So you have a 7-day survival gap where the production line is just dead.
And to prevent that, they have to spend money.
You have to spend real capital right now to build up safety stock, inventory buffers. And that ties up cash. It costs money to store. It kills your efficiency. It's a huge, expensive operational drag.
So the predictable, cheap world Bogle relied on is gone. But just buying a broad international index fund doesn't solve the problem, does it? Because those companies are exposed to the same broken system.
That's the key insight. The solution isn't just geographical diversification. It's investing in structural resilience. The really smart move here is to invest in the companies that are actually fixing this collapse.
It's resilience providers.
That's the new alpha, the new low-risk, high-return, if you will.
Okay, so let's define that. We're talking about smart port infrastructure, SPI. What is that exactly?
It's basically the tech that solves the problem. It's using things like automation, AI, IoT, and digital twins to make ports and logistics flows autonomous and optimized. It's the market's direct answer to that TTR-TTS gap.
And the market is growing.
It's exploding. The North America smart port market is forecast to grow at a CAGR of almost 28% through 2035. This isn't some niche tech play anymore. This is a fundamental overhaul of global infrastructure.
So let's break down the actual technologies. Where are the opportunities?
Okay, let's start with the most direct one: process automation and IoT. This is what closes that efficiency gap we talked about.
Who's doing this well?
Take a look at MSC, the world's biggest container line. They're using IoT sensors on their cargo for real-time monitoring. They can track temperature, security, location, everything. They're also rolling out digital bills of lading to get rid of paperwork, which speeds up customs and reduces fraud.
Okay, so that's making the current system faster. What about making it smarter, more predictive? That's where AI and digital twins come in, right?
Precisely. This is what helps you manage that cyber-physical shutdown risk. A digital twin is a virtual, real-time copy of the entire port.
So you can run simulations.
You can simulate, then act. The Port of Rotterdam is a leader here. They can run a simulation of a key crane going down or a sudden rerouting of ships, and they can calculate their time to recover before it actually happens. They can stress test their own resilience.
And the AI part takes it a step further.
It moves you from just monitoring to optimizing.
Yeah.
We're talking about AI for predictive maintenance on equipment, for rerouting cargo in real time to avoid bottlenecks. This is the jump from, Logistics 4.0, which was just digitization, to Logistics 5.0, fully autonomous, integrated, resilient systems.
That's the resilience those S&P 500 companies desperately need.
It's the only way they survive the 2026 environment.
Okay, one last piece. The regulatory burden, the carbon costs. What's the tech solution for compliance?
Blockchain. It has to be blockchain-based traceability. With new rules like the EU's digital product passport coming online, you need to prove where your product and its components came from.
Verifiable identity.
A verifiable, unchangeable record. The EU battery regulation in 2027 will require this. Blockchain provides that secure ledger. It's the only way to prove compliance at a global scale.
So if we pull this all together, traditional safe assets like treasuries, they give you safety and liquidity, but the returns are low. What does investing in smart port infrastructure give you?
It's an intrinsic hedge. You're investing in something that profits directly from the necessity of resilience. You're not betting on the fragile status quo to continue. You are betting on the mandatory, inevitable modernization of global trade.
So you're turning a systemic threat into a growth opportunity.
Exactly. The safety isn't just in preserving capital anymore. It's in backing the infrastructure that guarantees operational survival. So what does this all mean? It means the entire premise of Bogle's advice is over. The idea that U.S. companies were safely isolated and that logistics were cheap and guaranteed, that era is gone. The collision of carbon pricing, geopolitics, and cyber threats has broken that physical handshake.
So investment safety has shifted.
It's shifted from passive financial safety, like just holding an index, to active operational resilience.
The takeaway here seems pretty clear. The structural risk of 2026 demands a structural hedge. You have to stop thinking your S&P 500 fund is immune to these global failures.
Right.
And instead of just passively holding the U.S. companies that are basically hostages to this system, you invest in the tech firms and the infrastructure plays that are actually building the solution.
You're investing in the fix.
Right. So here's a final thought we want to leave you with. If the survival and the profitability of a massive port like Shanghai or a giant like MSC depends on fully integrating 5G, AI, and autonomous vehicles, what is the unquantified risk premium you should be placing on a company or a port that is still relying on purely manual, traditional operations? Just think about how much that gap, that resilience gap, is actually worth over the next decade.